Hello, everyone. This is Harjinder, and this is the last lecture video for Accounting 3224, Chapter 12, Decision Making. Our learning objectives for this chapter include how to identify relevant costs for decision making. We will look at specific examples of decision making involving adding or dropping product lines, the decision involving to make something in-house or to outsource and buy externally, whether to accept or reject special orders, how to decide if we should further process a product or sell something at split-off point when there are joint product costs incurred. And we will also look at how to utilize scarce resources so as to maximize operating income. Looking at the relevant costs for decision making, the definition of relevant costs is that these are costs which will differ among alternatives in a particular decision. And these are costs that will be incurred in the future. Some other names for relevant costs include avoidable costs, incremental costs, and differential costs. And identifying relevant costs for specific decisions can help us with decision making in several situations. It's important to keep in mind that these costs will be incurred in the future. So any cost that has already been incurred, we call that a sunk cost. A sunk cost is never relevant to a decision. The types of decisions that we'll be looking at include the decision of whether to add or drop a particular product line or a segment, the decision to whether make internally in-house some part or product or to outsource that particular process, whether to accept or reject special orders, and where joint products are produced, whether to sell or process further. A generic approach to decisions can be outlined. Basically, you have to keep in mind that all decisions involve a change from the status quo, i.e., whatever we are doing currently. So, for example, if the decision involves whether a product should be dropped, the status quo is currently we have the product, so we make and sell the product. If the decision is whether we should buy a part, the status quo is currently we're making it. So when you make the decision, you have to identify relevant costs and benefits of making the decision, i.e., from changing from the status quo. You want to compare the relevant costs to the benefits. If the costs are more than the benefits, then we would not want to make the change. If, on the other hand, the benefits are greater, then we would recommend the change. So this is, in a nutshell, the often used term of cost-benefit analysis. You'll compare the costs to the benefits, accept a change if the benefits outweigh the costs. So looking at the first decision of adding and dropping product lines, the relevant costs and benefits here would include the contribution margin that is lost if the product or the segment is dropped, the avoidable fixed costs if the product or segment is dropped, and the contribution margin that would be gained or lost on other products or segments if there's any kind of opportunity costs involved. What will be irrelevant to this decision would include any kind of allocated common cost and sunk costs. Depreciation can be seen as either an allocated common cost or a sunk cost. Depreciation essentially pertains to the allocation of the cost of a long-lived asset. And if the asset has already been purchased, depreciation will be recorded regardless of whether we will use that asset or not. So depreciation should never feature in a decision involving whether a particular product line should be continued or not. Here's a look at an example from the textbook, 12-20. So a donut shop makes three basic types of donuts: cream-filled, chocolate-filled, and jam-filled. The shop manager is analyzing the product mix and has collected the following information. You're given information on the sales price per dozen, the direct costs. Now, direct costs, if you've forgotten, is the direct materials and direct labor cost. The fixed overhead costs per dozen. So it's basically fixed manufacturing overhead calculated as per dozen donuts, and then the profit per dozen. So the chocolate-filled donuts apparently have a profit of $1.50 after subtracting 40 cents of fixed overhead costs per dozen. The cream-filled donuts have a profit per dozen of $1.60 after subtracting 50 cents of fixed overhead per dozen. And the jam-filled actually end up with a loss of 50 cents per dozen after allocating fixed overhead of $1 per dozen. The fixed costs, we are told, are unavoidable. They are allocated to each donut type based on the quantity produced. The donut shop has excess. So there's a bunch of requirements here. The first one is, which product should the donut shop promote if the promotion will result in an increase in sales of 50 dozen of the promoted product? So which one should we focus on if such promotion will result in more sales? So I mentioned that any kind of allocated costs are irrelevant to a decision. The fixed costs, we're told, are allocated to each donut type. No matter how they are allocated, the fact is any kind of allocation ends up being arbitrary. Okay, so maybe we allocate based on quantity produced, maybe we allocate based on some other allocation basis. But for decision making, fixed costs are unavoidable and should not feature in our calculation. So excluding the fixed overhead cost, if we were to calculate the contribution margin per dozen for these three types of donuts, we'll get, for the chocolate donuts, $1.90. For the cream-filled donuts, $2.10. And for the jam-filled donuts, 50 cents. So when we look at the contribution margins of the three kinds of products, we see that the cream-filled donuts have the maximum contribution margin per dozen. So if we could run a promotion that will result in more sales, our biggest bang for our proverbial buck would come from promoting the cream-filled donuts. That should be the product to promote. The answer to part one. Part two of the question asks us, should the jam-filled donuts be dropped from the product line? Now, when you look at the fact that the jam-filled donuts still have a positive, albeit small, but still a positive contribution margin of 50 cents per dozen, our recommendation will be to not drop the jam-filled donut line. They have a positive contribution margin. If we stop making the jam-filled donuts, remember the fixed costs are unavoidable and they are allocated to the donut types. Now, if we stop making the jam-filled donuts, our fixed costs are not going to reduce. And so that means that fixed cost will simply get passed on to the remaining product line. So we may end up having a mental satisfaction of still seeing some profitability, but the profitability of the chocolate-filled and the cream-filled donuts will be reduced. Okay? So you don't want to do that as long as the jam-filled donuts are still earning some positive contribution margin and we're not under some kind of bind of lack of capacity, we should continue to make the jam-filled donuts. Now, if on the other hand, part 3 says, if the shop is currently producing at capacity, well, then you have a bit of a, jostling for space. Then you may be able to drop the jam-filled donuts, provided the capacity that is released from not making the jam-filled donuts can be used to make and sell the other product, preferably more cream-filled donuts, but chocolate-filled is not bad either. So if we could make and sell the other kinds of donuts from the capacity freed up from not making the jam-filled donuts, then yes, we can stop making the jam-filled donuts. The second kind of decision is to make in-house or buy externally. The relevant costs for this kind of a decision include the incremental costs of making the product, the opportunity cost of utilizing space to make the product, and the purchase price from the external vendor. Irrelevant costs here would include any kind of allocated common costs and sunk costs. And when we mention the incremental costs, these should be incremental costs pertaining to the decision, right? So these are costs that will change between the two decisions. Any kind of costs that remain constant are essentially irrelevant. Here's an example from the textbook, exercise 12-3. Current Control Inc. manufactures a variety of electrical switches. The company is currently making all of its component parts. An outside supplier has offered to sell a switch to Current Control for $32 a unit. To evaluate this offer, Current Control has gathered the following information relating to its own cost of producing the switch internally. They make 12,000 units a year. The direct materials cost for each unit is $12, direct labor $10, variable manufacturing overhead $3, fixed manufacturing overhead that is traceable to this particular component part are $8. There's an asterisk indicating 25% is supervisory salaries, 75% is depreciation of special equipment. And then there is the fixed manufacturing overhead, which is common but allocated $16, giving us a total cost of $49. Now, if we were to compare all of this $49 to the $32 the external supplier has offered to sell the component to us at, it might be tempting to say, yes, let's go for it. $32 is significantly lower than $49. That, however, would be a mistake because out of the $49 of the total cost, $16 is the allocated fixed manufacturing overhead. We are not going to be able to avoid that particular cost. Out of the $8 of cost that can be traced to the product, 75% or $6 cannot be avoided because it relates to depreciation. And depreciation, as I mentioned, should not feature in our calculation because depreciation is unavoidable as well. So if we really do want to compare the cost or make this decision, we have to ask ourselves, if we accept the supplier's offer, then it'll cost us $32 per switch to buy. We can avoid having to purchase direct materials of $12. We won't need direct labor at $10 per unit. We won't need to incur variable manufacturing overhead of $3. And we can avoid supervisory salaries, $2. So the total amount that we are able to avoid by making a switch over to the external supplier is $27. When we compare $27 of the cost that we can actually save by not making to the cost that we'll have to pay to buy, $32, it ends up that each switch costs $5 more to buy than to make. Given the fact that we need 12,000 units a year, it will result in higher costs and therefore lower operating income of $60,000 a year, $5 times 12,000. Bottom line, if it's going to result in lower income, we should not make the change. So reject the supplier's offer in this case. Now in part 2, we're told, suppose that if the switches were purchased, current control could use the freed capacity to launch a new product. So now this becomes interesting because we have a alternative use of the freed up capacity. The segment margin of the new product would be $78,000 a year. Should current control accept the offer to buy the switches from the outside supplier each? So given the fact that we have now an alternative use for the spare capacity, even considering that we will be losing contribution margin of $60,000 from buying from the external supplier, when we consider that we can actually earn additional contribution margin or segment margin of $78,000 from the launch of the new product, the $78,000 of additional contribution margin from the new product is more than the contribution margin that we will give up from buying from the external supplier. We will still be ahead by $18,000. So under these circumstances, it makes total sense to accept the supplier's offer because it'll result in $18,000 of additional operating income. So notice your decision can change as the circumstances change. You have to make sure, though, that you are considering all the relevant facts. In the first case, there was no indication of any alternative use of the spare capacity. In the second case, given the fact that there is alternative use for the capacity, we were able to decide in favor of purchasing from the external supplier. Special orders. Now, the decision here is typically, do we accept the special order or not? So the relevant costs and benefits in this case will include the incremental costs of filling the order, the opportunity cost, if any, of filling the order, and the incremental revenues from the order. Once again, the irrelevant costs are any kind of allocated common costs and any kind of sunk costs. Exercise 12-10 from the textbook. At the Kicher company's current activity level of 8,000 units a month, the costs of producing and selling 1 unit of the company's only product are as follows. Direct materials, $5, direct labor, $6, variable manufacturing overhead, $1, fixed manufacturing overhead, $9, variable selling and admin expenses, $3, fixed selling and admin expenses, $4. The normal selling price is $26 a unit. An order has been received from a potential customer overseas for 4,000 units at a price of $24 per unit. So compared to the normal selling price, this particular special order, well, this particular order is at a cheaper price. So that'll make it a special order. This order will not affect regular sales. The company's capacity is 12,000 units a month, and enough excess capacity exists to fill this order. So we don't have any kind of capacity constraints, etc. We are well able to fulfill the order. First part of the question is, if the order is accepted, by how much will monthly profit increase or decrease? So the order is not going to change the company's total fixed costs. So ignoring the total fixed costs, basically for the special order, we're going to have a selling price of $24. And our variable costs will be the direct materials, direct labor, variable manufacturing overhead, and the variable selling and admin expenses. So that'll add up to $15. Each unit will bring in contribution margin of $9, and the order is for 4,000 units. $9 times the 4,000 units is additional contribution margin of 36,000. With no change in fixed costs, all of the $36,000 of additional contribution margin will be reflected as additional operating income. So we'll have $36,000 of additional operating income if we were to accept this special order. Part two is a little different. Says, assume the company has 500 units of the product left over from last year that are inferior to the current model. These units must be sold through regular channels at reduced prices. Whereas what unit cost is relevant for establishing a minimum selling price for these units? Now, this would be an extreme example of how low can we go. Well, the units have already been produced. So we're not going to have to make the units. So the costs of making the units is not relevant. The fixed costs are not relevant. The only relevant cost, therefore, would be the variable selling and admin costs of $3 per unit. All the other costs are sunk costs. Now, this doesn't mean that the company should price the product to sell at $3. Then they're not going to make any sort of profit. But in terms of deciding how low can we go, well, certainly the company cannot go lower than $3 per unit, because at a lower than $3 per unit, they will actually end up incurring extra out-of-pocket costs. If they were to sell the product at $3 per unit, they will basically be recovering the extra selling and admin costs. They will not have recovered any of the production costs. Although, the production costs are sunk costs, the company will still try to sell the product for more, as much as it can. It can certainly not hope to sell the product at $26 per unit. Okay, so you kind of get a range for where, at a minimum, the company will need to price the product at $3. Anything more than $3 is good. The next kind of decision to look at is the decision of whether to sell something or to do more work and process it further. Now, joint product costs arise when two or more items are produced from a common input. In deciding whether to sell the products at the intermediate stage or to do more work and process them further, the relevant costs and benefits include the incremental costs of doing the further processing and the incremental revenues from the further processing. What we should not pay attention to is the allocated joint product cost. Example 12-17. The Fraser Paper Company produces large rolls of white paper weighing 1,000 kilograms for wholesalers for $1,500 each. So that's the selling price. Each roll is 1,000 kilograms and is sold at $1,500 each. The wholesalers then cut the product, the paper, into standard size sheets and package it in 2-kilogram packages. These packages are sold to printers for $4 a package. There's no waste in the cutting process. Fraser paper currently produces 5 million kilograms of paper annually at a fixed cost of 1 million and variable cost of 80 cents per kilogram. Now, this cost of $1 million and variable cost of 80 cents per kilogram, this is irrelevant because Fraser company will still continue to produce the rolls regardless of the decision we make in this particular issue. So what is the issue? Well, Fraser has an opportunity. Fraser can bypass the wholesalers. So this would be an example of sort of doing kind of a vertical expansion. So rather than sell large rolls to the wholesalers, Fraser could bypass them and cut its own paper for sale directly to the printers. Now, if they do that, Fraser will have to add equipment and personnel with an annual fixed cost of $650,000. Incremental variable costs would be 10 cents per kilogram. So the question is Fraser better off by cutting its paper, or should it continue to sell to wholesalers? So the status quo is currently we sell to wholesalers. So if we sell to wholesalers, with 5 million kilograms of paper produced annually, and the selling price is $1,500 for each roll of 1,000 kilograms, our current sales work out to $7.5 million. Our alternative is to cut our paper. So if we were to cut the paper, we will be able to sell it in 2-kilogram packages at a price of $4 per package. So 5 million kilograms will then result in annual sales of $10 million. But this annual sales of $10 million will require us to actually cut the paper. And so the incremental cost of doing the processing will include a variable cost of 10 cents per kilogram. So 5 million kilograms times 10 cents, that's an extra 500,000, plus annual fixed costs of 650,000. So that adds up to $1,150,000. From the $10 million, if we take out the $1,150,000, we get net sales after the processing costs, $8,850,000. If we compare the $8,850,000 to our current sales of $7.5 million, then certainly this is a more attractive option. So the recommendation in this case will be that given the fact that we have a net benefit from cutting our paper of $1,350,000, Fraser should cut its paper instead of selling to wholesalers. The last kind of decision pertains to the utilization of scarce resources. The theory of constraints applies in this case. A constraint is defined as a limitation under which the company has to operate. The examples could include limited amount of machine time, limited labor time, or limited demand for the product. And managers have to try to optimize the use of scarce resources by determining the profitability index, which is calculated by, well, basically it is looking at the contribution margin for each unit of the scarce or constrained resource. It may be possible for a manager to relax a constraint by, for example, if we have a constraint on labor time, we could bring in more overtime hours, but that would mean possibly differential costs and so on. So that kind of decision is made by managers all the time as to which products produce and in which quantity, how much, in what quantity will result in the maximum amount of profitability for us. So there are a few steps involved in a typical problem. You want to first calculate the contribution margin per unit for all the competing products. You will then calculate the amount of the constrained resource per unit produced. So if it's direct labor hours, then you'll calculate how much of direct labor hours are needed for each unit. You want to divide the answer in part 1 by that in part 2 to get the contribution margin for each direct labor hour. And the purpose for doing that is to rank the competing products in terms of the highest profitability to the lowest profitability for each unit of the constrained resource. Finally, you will allocate the constrained resource among the competing products according to the ranking done in part 4. We'll take a look at an example. This is an example of an old final exam question. We're given information about Joey Clothing Manufacturing Limited, a maker of a line of dress and casual clothing. Recently, sales have been increasing rapidly. Management is concerned that there may not be sufficient capacity to meet next year's sales demand. The following information is available for planning purposes. So they've got 6 types of products: dress pants, casual pants, jeans, jogging pants, cargo shorts, and sweatshirts. You're given the estimated demand in units or pairs, as the case might be for the pants, the selling price, the direct materials cost per unit, the direct labor cost per unit. In addition, we're told that the direct labor rate is $20 an hour. The fixed manufacturing overhead costs total $375,000 each year, but that is not relevant to our decision. The variable overhead costs are equal to 25% of the direct labor costs. Now, variable overhead costs will be relevant for our decision because when calculating contribution margin, we will need to include variable overhead costs. The manufacturing plant capacity is 30,000 direct labor hours. So that's one of the constraints, the availability of labor time. The other constraint is the estimated demand. The selling and admin expenses are all fixed. If they're all fixed, not relevant to our decision. We're asked what products should be produced and in what amounts to maximize operating income. So here we will try to calculate the quantity, the items and the quantities to produce. We will start out with the selling prices that are given to us in the problem. Dress pants sell for $60 a pair, casual pants $45, jeans at $30, jogging pants at $25, cargo shorts at $18, sweatshirts at $20. We'll also look at the variable costs. We were given information on the direct materials and the direct labor, the per unit costs. So these are the per unit costs provided in the problem. We were also told that the variable manufacturing overhead costs were equal to 25% of the direct labor cost. So for the dress pants, since each unit needs direct labor cost of $15, $15 times 25% gives us variable overhead of $3.75. Similarly, we can calculate the variable overhead cost for the casual pants, 25% of $12, $3. For the jeans, 25% of $5 is $1.25. For the jogging pants is $1. Cargo shorts, $1.25, and sweatshirts is $1.25 as well. Add the direct materials, direct labor, and the variable manufacturing overhead, and you get the variable cost per unit. Subtract the variable cost per unit from the selling price, and you get contribution margin per unit. So for dress pants, $60 minus the $46.75, we get $13.25 a pair. And likewise for the other products, you can calculate the contribution margin per unit. Now, if we were to just look at this contribution margin, we'll feel that the jeans seem to have the most contribution margin per unit. And cargo shorts are the least bit productive, the least profitable. However, that would be a mistake, because when we are looking at the constrained resource is direct labor hours. So we need to calculate the contribution margin per direct labor hour, right? We need to calculate the contribution margin for each direct labor hour. And to calculate that, we need first how much of direct labor hours are needed for each unit produced. Now, how do we get to that? Well, the question told us that the direct labor cost is $20 per hour. So for the dress pants, the direct labor cost to make one unit is $15. $15 divided by the $20 wage rate gives us 0.75. That's how much of labor time is needed to make a pair of dress pants. For the casual pants, the direct labor cost is $12. $12 divided by $20 per hour gives us 0.6 of an hour. Similarly, we calculate the direct labor time needed to make a pair of jeans, jogging short pants, cargo shorts, and sweatshirt. Next, you want to divide the contribution margin for each unit by the amount of labor time needed to make that unit. For dress pants, each dress pant we sell earns us a contribution margin of $13.25. And each dress pant pair takes 0.75 of a labor hour to make. So the contribution margin for each hour of labor time is calculated by dividing $13.25 by 0.75 labor hours needed to make each unit. 13.25 divided by 0.75 gives us $17.67. Likewise, for casual pants, $9 divided by 0.6 is $15. For the jeans, 16.75 divided by 0.25 is $67, and so on. Now that we have calculated the contribution margin for each of the products for every direct labor hour, we can now go ahead and rank the products in terms of most profitable. So jeans clearly are bringing in most amount of contribution margin for every direct labor hour, so $67, followed by jogging pants, followed by the sweatshirts, followed by cargo shorts, then dress pants, and then finally the casual pants. That's our ranking. Now we're going to take a look at the estimated demand. Well, these are the number of units of estimated demand. Considering that each unit needs this much of labor time to make 8,000 dress pants at 0.75 labor hours per unit, the direct labor hours needed, 8,000 times the 0.75, works out to 6,000. For the casual pants, 10,000 pairs times 0.6 of a labor time gives us 6,000 hours again. For jeans, 17,500 pairs times 0.25 is 4,375, and so on. Now, if you were to try to make all the units, and this should be our first attempt as a business, as long as the product earns positive contribution margin, you'll try to produce as many as you can sell. However, looking at the number of hours needed, the total number of hours add up to 32,375. We don't have 32,375 hours, unfortunately. We only have 30,000 hours of labor time available. So we're going to be short by 2,375 hours. So that's the number of labor hours that we'll have to cut back. Now, where will we apply the cuts? Because our objective is to maximize operating income, we will apply the cut of this 2,375 hours to that product which has the lowest profitability. So the lowest profitability is, in this case, for the casual pants. That's the lowest, the least bit profitable. So we will reduce the labor time allocated. So if we were to make all of the 10,000 pairs of casual pants, we would have needed 6,000 hours of labor time. However, since we don't have that much labor time, we will cut back 2,375 hours from the casual pants. For the other products, we will allocate as many labor hours as are needed. So what does that mean then? How many units? What is the quantity that we will produce? Well, the long and short of this is that as far as the jeans, the jogging pants, the cargo shorts, the sweatshirts, the dress pants are concerned, we can produce all of the units that are demanded. But for the casual pants, given that we only have 3,625 hours available and each pair needs 0.6 of a labor hour, we can only produce 3625 divided by 0.6. And keep in mind that we can produce a fraction of a unit, so you want to round down 6,041 pairs. We can't produce the 10,000 pairs of casual pants. The maximum we can produce, given our capacity constraint of labor time, is 6,041. Okay, so this was an actual exam question. The current textbook does not have good examples or problems of this nature anymore. However, I suspect that your final exam could include a question of this type, or at least this level of complexity. So in the lesson notes, there's another question that is included. You would want to go over that question on your own time. We will try to take up examples in class as well of decent questions that are of reasonable complexity and challenge. And yeah, I think this will be a chapter that we will all enjoy doing, because it is the last chapter for this course, and B, it is a chapter that is possibly the most meaningful in terms of applicability to different facets of business. So I look forward to doing those examples in class. Until then, please study hard, and the end is near. Bye-bye.